Quantitative easing, QE, is a form of monetary policy in which a central bank, like the U.S. Federal Reserve, purchases securities from the open market to reduce interest rates and increase the money supply. Quantitative easing creates new bank reserves, providing banks with more liquidity and encouraging lending and investment. In the United States, the Federal Reserve implements QE policies. Understanding quantitative easing, QE, quantitative easing is often implemented when interest rates hover near zero and economic growth is stalled. Central banks have limited tools like interest rate reduction to influence economic growth. Without the ability to lower rates further, central banks must strategically increase the supply of money. A government's fiscal policy may be implemented concurrently to expand the money supply. While the Federal Reserve can influence the supply of money in the economy, the U.S. Treasury Department can create new money and implement new tax policies with fiscal policy, sending money directly or indirectly into the economy. Quantitative easing can be a combination of both monetary and fiscal policy. Does quantitative easing, QE, work? Most economists believe that the Federal Reserve's quantitative easing program helped to rescue the U.S. and the global economy following the 2007 to 2008 financial crisis. However, the results of QE are difficult to quantify. Risks of quantitative easing, QE, inflation. As money is increased in an economy, the risk of inflation looms. As the liquidity works through the system, central banks remain vigilant, as the time lag between the increase in the money supply and the inflation rate is generally 12 to 18 months. A quantitative easing strategy that does not spur intended economic growth but causes inflation can also create stagflation, a scenario where both the inflation rate and the unemployment rate are high. Limited lending. As liquidity increases for banks, a central bank like the Fed cannot force banks to increase lending activities, nor can they force individuals and businesses to borrow and invest. This creates a credit crunch, where cash is held at banks or corporations hoard cash due to an uncertain business climate. Devalued currency. Quantitative easing may devalue the domestic currency as the money supply increases. While a devalued currency can help domestic manufacturers with exported goods cheaper in the global market, a falling currency value makes imports more expensive, increasing the cost of production and consumer price levels. Quantitative easing is a type of monetary policy in which a nation's central bank tries to increase the liquidity in its financial system, typically by purchasing long-term government bonds from that nation's largest banks, and stimulating economic growth by encouraging banks to lend or invest more freely. Is quantitative easing printing money? Critics have argued that quantitative easing is effectively a form of money printing, as it increases the money supply in the economy. However, proponents argue that it is not the same as printing physical money, as it involves the creation of electronic reserves and the purchase of financial assets.